freedom isn't the result of wealth, it's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here today, as always, with the one and only Adam Penn. Adam, how are you?
Do we have to do this every time? We've talked about this. Not the one and only. There's the guy that wrote the Stranger Things thing.
What am I supposed to say, though? Like the one of two Adam Penn? Like that?
One of two that we know. I'm here with the one of two that we know, Adam Penn.
It just doesn't have the same ring to it. It's better to say one and only.
Anyway, we're here.
You're the one and only Adam Penn.
And I'm the one and only.
Okay, good. I'm glad. Just keep saying that over and over and you'll internalize it. It'll be good.
I'm the one and only.
There you go.
Perfect. I'm glad we got this. How is it out there in Eastern Tennessee?
Well, it's actually really nice. We're, I don't know exactly when this episode will air, but we're recording this in early September and we're having a hint of unseasonably cool weather where it's just
September for you out there?
What's that?
It's September for you out there?
It is, yes. What is it out there on the left coast?
Oh, we're still in August. Takes a while for it to.
I'm sorry.
Yeah,
takes a little while for the new month to get out there. I understand.
Yeah.
No, it's actually really nice. We're getting into fall. Fall's my favorite time of year. I got my Tennessee themed polo on here today. So I love fall. It's just beautiful. The leaves change. This is a beautiful part of the world. I love East Tennessee. We got the mountains and got nice colors and nice weather and crisp, cool nights and mornings. And I just love fall. Fall's great. And then you get all the pumpkin stuff and pumpkin spice this and pumpkin spice that. And
you seem like a pumpkin spice latte type of person.
I am unashamedly a fan of a pumpkin spice latte. I've already had several so far this year. They just came out. So
wow.
Good stuff, man. I'm telling you, I love fall. It's the best time of year. It's my favorite season.
Well, you had a topic you wanted to talk about today. You want to summarize
I feel like we should have reversed that. I was actually about to kick it off over to you and say you had a topic you wanted to discuss today. So instead of me reading your mind, why don't you tell me what's on yours?
So I was thinking we could talk about how people don't take things that I think could be learning lessons as learning lessons and instead walk away from future opportunities because something bad has happened. And a lot of this stemmed from, I've been doing some outreach. We've got an oil deal we're closing out right now. And so I've been texting investors, and we got 100 people or so that we have on our list. So normally when we get close to the end of the deal, I'll start sending personal texts out to people. And so I was sending some out yesterday, and I don't know, not a lot, but maybe as much as 10% of the people that we're reaching out to are responding with something to the tune of, I've lost money in 3 deals and I got another one going sideways, or I lost half my net worth over the last 4 years, or, something, right? And it's not everyone. Like I said, it's 5-10% of the list, and it's not huge. But the thing that, you see that once, I had someone tell me that a while ago. I'm like, oh, man, that sucks. And we talked about it for a little bit and things of that nature. But when I started to see it over and over, right, because we sent 40 text messages yesterday. And when I saw that on repeated, I think we got 3 back that said that yesterday, every one of those people was so dead set on never doing a syndication again or never doing private real estate outside of just their own investing. There was one person who said, we're incredibly successful real estate investors. It's just a shame that we lost money in syndication. And I'm like, to me, that was grouping a bad time in the market, maybe some overzealous sponsors and people betting onto returns that maybe were unrealistic, bad market timing, with really preventing themselves from having opportunity in the future. I think if and I've had a deal that's gone completely sideways, right? We did an oil deal, and that was a loss of capital, and from that, I didn't say. I mean, I wanted to for a little while. I didn't say, hey, we're never going to do an oil deal again. or we're never going to raise money again. It was, what can we learn from this that we'll never make that mistake again? And I think that was a better way to look at it. And I think that it's allowed us to then now have opportunities that, I mean, right now, me and you are seeing more opportunities at our desk than we've seen in the last 4 years, right? We see deals at Pencil, we see projects that we want to work on, we see rents going up on properties we have, we see, I see deals. And a lot of the deals one deal in particular that I bought recently from someone was because they've just had such a bad 3 years. They're just done. They can't do it anymore. Right? They're done. And they literally handed the keys to me. I gave them, it was a $600,000 building. They paid $800,000. I gave them $12,000 and they handed me the keys and the mortgage. Wow. It's just a little crazy. And so, I don't mind getting deals like that, but at the end of the day, I think what my point here is that there should be a learning experience in everything, right? The deals that go great, what did we learn from that? And the deals that went bad, what did we learn from those? And I think it's too often we're seeing people kind of wash their hands of an entire space because some deals went bad. And I think they probably would become very successful investors if they took all of those things they learned on those 3 deals and use that to analyze new deals. And even one of the people that said they're never going to do another deal, they said they're incredibly successful real estate investors. Well, if you end up doing a deal and you don't have enough capital in your own pocketbook to do it, let me know. I'd love to take a look at it with you, right? I've known these people for 4 years and wouldn't mind maybe either putting some of my own money in it or working with other people and putting a small group together. Yeah.
I mean, this is definitely a recurring topic. I think you and I have both heard this, and we both know people who've, like you said, who have lost money. And that's tough. I mean, it has been, I think you've probably got more people that have, well, I don't know if this is a true statement or not, but it feels like you had a higher chance of having a deal go bad if you invested, let's say, between the end of 2020 and start of 2022, right? Maybe into 2022. Those investments probably weren't going to do that well, right? It was the height of the market. You got things that were overvalued, people overpaid, valuations that were never going to be able to be actually realized, right? And especially once interest rates started going up, expenses started going up. But
especially
then also,
if they were short-term deals, right? A lot of the multifamily there was value add, flip it, and be done in 3 years, and that's just not what happened.
But you also saw a lot of things that tend to happen at the end of bull market cycles, right? And namely frauds, Ponzi schemes. I mean, true full-out Ponzi schemes. And we know several investors that, in addition to being in deals that just went bad, it was a real deal, and everything went against it for all manner of reasons. They were also involved in maybe one or multiple full-on Ponzi schemes. And so, I think there's a lot of different angles here. I look at, I think the thing that immediately comes to mind, or there's a handful of folks that I can think about who you and I both know who did not really invest in anything passively. They might have been doing their own deals, right? Like they were actively involved in some stuff. But in terms of passive investments, in the height of all of that, really from like 2019 until maybe a year or so ago, they just weren't doing anything. And it wasn't necessarily out of fear, but it was because the indicators that they saw were getting into the range that it was like, we are more likely to have a negative outcome than a positive outcome on this, and it's not worth taking that risk. And so they sat on their hands. And early in the cycle, that's a very hard thing to do, especially the early portion of the end of the cycle. That's hard because it's kind of the blow off top. It's when everybody's making the most money. You're seeing these crazy returns, and it takes a lot of discipline to sit there and not participate, right? Which is why you get frauds and other things that happen late in the cycle. But now those same guys are deploying a lot of capital because they're seeing opportunity right now. And so, some of that, again, there's multiple lessons to be taken away from it. I think one is always, if you've gotten burned, you always have to be aware of where you stand in the cycle. And does any given deal make sense? Is it, overhyped? Is it overvalued? The cap rates have gotten way too compressed and there's absolutely no way they're going to continue to go down from here, or we're buying in a deal that's projecting 10% annual rent growth for the next 7 years. Like, unrealistic stuff. So there's things that like you can take to keep from getting into those deals at the first. But even if you've lost capital, that doesn't change the fact that this is a different environment. We are not in the same environment we were at the very end of that cycle. We've come off the top. There's definitely been pain, and we've now kind of gone down. You can argue how do we have more further down to go?
How far have we gone?
Exactly. But the point remains that there are, as you've said, there are more deals. You and I have seen more deals in the last, I don't know, probably 6 to 9 months, good, like solid deals, than in the last few years. And so we feel like it's a decent time to be deploying capital into solid deals. It's always a good time to deploy into solid deals. There's just more solid deals now than there have been. And so it's a real risk.
Less competition too right now.
It's exactly right. Yeah. And because you've got some of this, a variety of factors, you've got people that should have never been raising money for deals and doing deals. They've been washed out because they did bad deals and they're no longer in the game. Or you got people that aren't interested anymore because they have lost money. There's better deals and less competition for them, which is a really good setup. But that can be hard if you've sitting here, you've taken losses for the last few years, and even some other deals that you haven't realized the loss yet, but you're like, this one's probably coming. It's hard to sit there in the face of that and deploy new capital. But the reality is this is how it always works, right? Like one of the best times to like back up the truck and buy real estate would have been in 2012. And that was when nobody wanted anything to do with real estate. And properties were, going to foreclosure and being auctioned off for pennies on the dollar on the courthouse steps. And the people that made the most money were the ones that were like, nope, right now is the time to be buying. Like, I know that it's hated and other people have just spent the last 4 years losing money in real estate, but we're going to buy because we see opportunity.
Yeah.
And this sort of stuff always happens every cycle, right? And I think that's another thing when you're trying to look at like, what are the signs of where we stand in the cycle? I think the sort of hated asset class, or like, I'm never doing any of this again. That's typically, you don't see that attitude at the top. You see it more towards the bottom. And so I definitely think that we're staring at a good time to be deploying capital into solid deals. I think we've got a lot more upside ahead of us now than we have downs. I wrote about that recently, and some stuff with some interest rates in the newsletter. But I definitely see more upside than downside in the future for us.
One thing that is interesting to me is you'll have those same people that say, "Oh, we've lost money," and it's like they're unwilling to even look at new deals, right?
Yeah.
Like, was it just because they're so blindsided by the one they lost and they thought they had analyzed everything on it, right? I mean, I get that the loss hurts. Don't get me wrong.
Yep.
But like I said, we've lost money on stuff that still sometimes you even have to manage while you're losing money, right? And you got to manage the fall down the hill. But to me, there's one of our mentors says, you get good at looking at deals by looking at deals. And so if someone shows me a deal, I might not spend an hour on it. I might not spend 5 minutes on it, but I'll probably look at it, right? I mean, right before we started recording this podcast, we got an email from a broker, and it was an apartment building, and me and Dustin spent probably 5 minutes to decide that this is not something we're interested in. It was a little bigger than we want to take down right now. I mean, I don't know. It wasn't bad. It was 158 units. It was about the right price, $80,000 a door, but it wasn't in the part of town we wanted. It was college housing in a market where the college isn't doing amazing. And we just said, no, we don't want to do it, right? But we took the minute to look at it and understand the deal, not just say, I've heard about apartment buildings and they've been doing bad right now.
Yeah. Yeah. And I mean, that honestly, you go back and you look at some of the numbers on this thing that we quickly looked at, it wasn't really the quality of the deal maybe that we were saying no to. I mean, it was, $80,000 a door for multifamily, which multifamily / student housing. So you can argue that, but that's a fairly attractive price point in this market. In any market, shoot, 80 a door in California. That's that's pretty good. Yeah. But there's just other factors. So I think that kind of speaks to the fact, we haven't written it off. We never did, right? We're still looking at deals. And even, there was a whole lot of stuff that during the height of the market, we weren't chasing valuations, and I was definitely trying to stay disciplined and underwriting on things. And, we offered on, even last year, there were some things where we were offering on some larger properties, and we just weren't willing to go above, we're not going to chase a price, right? Just because we want an asset. And we kind of pair that with, again, your idea of we've still been looking at deals. We're looking at things. We're staying disciplined, trying to find those good deals, because it really doesn't matter the environment that you're in. If it's a solid deal and you're not making unrealistic assumptions, it's likely to be fine. And that you go through phases where there's more of those or less, but we've never turned off from multifamily just because it's like, well, this sucks and there's no opportunities to be had. We just have had a fairly decent amount of time where we've not been doing a lot of deals because there just haven't been good deals. And so we're not, unlike a lot of people that are losing money right now, we're not going to do a deal just for the sake of doing a deal.
I think one of the things to talk about loosely is, we can go two directions, right? We can go, what were some of the signs that we've seen about deals that have gone bad, and what were some of the things we looked for? And then the second one is just loosely about position sizing. We've mentioned this a lot before, but I talk to investors all the time, and we don't take more than 10% of their net worth in any one deal, right? That's not an SEC regulation, but I think it's a pretty decent rule. If someone's got $1 million net worth, I don't want $400,000 of their money, even if they're accredited, right? By definition, they're accredited. They can do what they want with their money, but I don't want that, because if that one deal goes bad, I got to make like a 90% return to get you your $400,000 back on your other $600,000. You're probably not going to give me that other $600,000, so you got to go find that someone else. But if you lose $100,000 on a deal, or let's just say you put $200,000 in a deal, right, a little higher, 20% of your net worth, and you take a 50% loss on it, market shifts, whatever happens, you've got to make a 10% return to a 13%, it's an 11% return on your remaining $900,000 just to get back to your $1 million mark, to be back at your beginning. It doesn't count for inflation and all the other things. But I just think position sizing is important, right? Because if you really did have, only did 10% of your net worth, right? Losing money on 3 deals does suck. But it's also, it was 30% of your net worth, but that should mean that your other 70% was earning during that time. So you're probably loosely at it. And if they were all earning 10% returns, you're probably loosely back at where your break even was, right? And that's investing is up and down. It's better if it's just up, right? The safer returns for a more consistent amount of time and only outperforms the ups and downs. But then, the second thing to look for is, those deals that went bad, what happened, right? Was it a fluke, right? I know buildings that have just burned down, right? A tenant had a stove catch fire and the thing burned down and cash flow dried up. They had to deal with insurance for 2 years. That stuff happens. But was it because, we just did an episode on cap rates, and was it about cap rates going super far down, right? Or they started at 4% cap rate, and now we're at 7s and your building's worth half of what it was. I think analyzing the reasons things go wrong and what made you make those decisions up front is way more valuable than just saying, I don't do syndications anymore.
Yeah. And that in and of itself can be hard, right? Because a lot of times in this, you just want to ignore this pain. And it's like, no, I don't want to think about that anymore. And I think that's sort of the mindset that leads a lot of people to say, I'm just not going to invest in this. I'm done. It's avoiding the pain, which is understandable. But at the same time, what are the long-term effects of that, right? Like if you're looking at your own wealth building and, your overall investment strategy, that probably isn't the best decision to just completely ignore something that is otherwise okay and might have gone through a rough period and made some bad decisions. I do think, Adam, your point about position sizing, I think that's one of regardless of we can talk for days about red flags on deals and what to look for, but one of the biggest things to safeguard your own personal net worth is position sizing, right? And not getting overexposed to any one particular deal, or even, you can look at it as per deal or per asset class or per geography or per sponsor or something like that. Like those levels of concentration. If you're trying to be aggressive and grow your wealth, you typically want to get concentrated. Most people that are investing in real estate are typically looking to preserve what they have and slowly build it, right? And so at that point, diversification will tend to make more sense. I think that's it's the thing. If you want to grow, you concentrate. If you want to keep what you've got, you diversify. And I think that the position sizing is one of the best ways you can safeguard yourself outside of any other discussion about deal specific sorts of things. If you're not overexposed to any one particular, again, deal, geography, sponsor, whatever.
I mean, that's the thing that I think is so cool about real estate is instead of having, a stock portfolio where you probably are going to be more concentrated just by nature of the way the stock market works. If you have a $2 million real estate portfolio, you could have $100,000 in 20 deals, 20 different assets. You could have it in 20 different single family homes, however you want to do it. And you only have 5% in each individual one, right? You could put half of that into single family homes and have 5% in, 10 homes, and then put the other half into, $100,000 deals and have the syndication side of it. I mean, there's just $100,000 is not a trivial amount of money at all, but there's ways you can protect that overall wealth instead of just saying we're not doing this again.
I don't know. I don't want to belabor this on, red flags about deals. I mean, I certainly think I think the bigger thing is like we said, or like I mentioned earlier, being aware and conscious about where we are in the cycle and the just overall risk present in the macro environment, and being more hyper aware of how you're deploying capital in those types of environments. And I think, Adam, when you mentioned position sizing, that was another thing I thought, okay, that's sort of I feel like that's another flag or another sign of the times, so to speak. When you get people who are way over allocating to a certain kind of thing, that sort of stuff tends to happen late in cycles. And we certainly saw that, right? We saw people way over allocate to full-on Ponzi schemes because the returns were so crazy, and they thought, well, I can't turn that down, and I'll just deploy as much capital as I can into it. And that's ended up for some folks going straight to zero. And again, that's another sign of the times. And so if you see a lot of those things going on, if you see returns that are too good to be true, if you see people starting to over allocate and do that, that's probably a time to be much more aware about have a higher level of scrutiny into the deals that you're looking at, and certainly be aware of position sizing, even though that's going to be the hard decision to make in the face of, you hear all of your friends talking about how this investment's going so well, and we've got these returns and this has been great and the market's ripping and all sorts of things like that. Being aware of that and just never turning, if you like a certain asset class, we like apartments. I mean, I think there's a lot of macro reasons to be liking apartments for the next several decades. And even though we've gone through a tough time and values are down and it's not been the best environment for finding deals, we haven't just written the sector off, right? It's like, well, this sucks, we're going to go do something else, or we're just going to ignore this, right? Like we know that the macro level opportunity is still there, so we're still going to look for deals. And yeah, it's been frustrating, and there's obviously been some losses for some people, but it's not a reason to completely move away from a certain type of investment strategy.
I think maybe to wrap it up, the part that is just kind of popped in my head, right, is we've been looking for multifamily for 3 years. We bought a handful of single family over the last 3 years, but we just closed on a 20 unit. It was the first real multifamily purchase that we'd personally done. And that deal came from the fact that we were still doing all of the things that we would have done while we were looking for deals for the first 3 years, or while deals were going sideways, right? We were networking with people. This deal came out of a local investor lunch that I do. If you're in the Chico area, hit me up, in Northern California area. But we do a monthly investor lunch, and there was a guy selling a building. They just literally said it at the end of one of the meetings, and he said it to me and one other guy, hey, I'm selling this building and that building. And then over a 6-month period, we slowly ran the numbers, negotiated the price. He's like, oh, my partner thinks it's worth this. I think it's worth this. And I said, well, this is what my numbers show. This is what I'll pay. And then we just kind of went back and forth. It was a super easy transaction, no brokers involved. And we're able to, by looking at deals, we were able to purchase the asset.
No, staying in the game's a very important thing. So I guess that would be my sort of final encouragement here, is even if you've been burned, don't let that completely shy you away from something that isn't inherently bad. And especially if you got burned by deals that were done in an environment where it was the end of a cycle and you got caught up in that, whether you realized it or not, you got caught up in the very top of the cycle and then experienced the losses that come with that. It's the natural part of it. It sucks, but at the same time, it's probably not a strong enough reason to completely write off an entire investing strategy or investment space as a whole, especially now in the face of, we've sort of come out of that and we appear to be back on the or at least maybe leveling out and slightly on the upswing right now is the best time in at least the last 3 years to be deploying capital. Anything else, Adam?
Nothing else for me.
Very nice. Well, everybody, we appreciate you listening. If you've enjoyed this, go give us a like on all the platforms and a thumbs up and a nice positive comment wherever that is, wherever you're finding us. Let the computers know that you're enjoying this, and so they can push it to more people and let more people enjoy it. But we, as always, appreciate you listening. We'll catch you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.